Good morning and welcome to the Cimarex second quarter 2020 earnings release conference call. All participants will be in a listen-only mode. Should you need assistance, please signal a conference specialist by pressing the star key followed by 0. After today's presentation, there will be an opportunity to ask questions. To ask a question, you may press star then 1 on your telephone keypad. To withdraw your question, please press star then 2. Please note this event is being recorded. I would now like to turn the conference over to Karen Acherno, VP of Investor Relations. Please go ahead.
Thanks, Danielle, and good morning, everyone. Once again, welcome to our second quarter 2020 conference call. An updated presentation was posted to our website yesterday afternoon. We may reference that presentation on our call today. So just as a reminder, our discussion will contain forward-looking statements. A number of actions could cause actual results to differ materially from what we discuss. You should read our disclosures on forward-looking statements in our news release and in our latest 10-K for the year ended December 31st, 2019, for the risk factors associated with our business. We plan to file our 10-Q on Friday, August 7th. Our prepared remarks will begin with an overview from our CEO, Tom Jorden, followed by a few comments from Cimarex CFO, Mark Burford. Blake Sturgo, VP of Operations, will then provide a brief operational cost update. Also present on the call to answer questions is John Lambert, EVP of Exploration. As always, and so that we can accommodate more of your questions during the hour we have allotted, we'd like to ask that you limit yourself to one question and one follow-up. Feel free to get back in the queue if you like. So with that, I will turn the call over to Tom.
Thank you, Karen, and thanks to all of you for joining us on the call, and thank you for your interest in Cimarex. The second quarter was a wild ride. I want to acknowledge the tremendous dedication and professionalism of our organization. This was particularly evident in the second quarter, during which most of our office staff worked remotely. Our field staff scrambled to manage production shut-ins while achieving outstanding safety performance, and we scrubbed every element of our cost structure to preserve cash and maximize cash flow. We began staging our office workforce back in May and currently have approximately half of our office workforce back. We are cautiously pleased to report that we have not had a single occurrence of workplace transmission of COVID-19. This includes office and field. During this time, with the dual challenges of a business downturn and a health crisis, our employees have given it everything they have. They have responded with drive, creativity, teamwork, and a willingness to examine every aspect of our business in response to these challenges. I would like to acknowledge this tremendous effort and express my personal thanks to each and every member of our team. It has been an interesting earnings season thus far. Clearly, most of us in the independent E&P sector are embracing the new demands of Shale 3.0. During this call, you'll hear a refreshed outlook from Cimarex. As we look ahead to 2021 and beyond, we are setting goals for ourselves and crafting long-term plans that allow us to focus on generating free cash flow, growing our dividend, decreasing our debt, and demonstrate that our assets can sustain a financially responsible future that puts our shareholders first. The days of investing every bit of our cash flow for maximum growth are gone. Our long-range plan involves spending a reduced portion of our cash flow, 70 to 80% as a target, and generating significant free cash. Our plans for 2021 and beyond are based on the assumption of $35 NYMEX oil and $2.50 NYMEX gas, with which we can maintain our production, grow our dividend, and generate free cash in excess of our dividend. Commodity pricing in excess of the $35 $2.50 assumptions will allow the opportunity to accelerate our free cash generation. Mark will discuss this in more detail. We're also examining every aspect of our cost structure. This includes capital expenditures, operating costs, and G&A. Blake will provide an update on our capital and operating costs. We have made great progress here, but we have more work to do. During our last call, we were in the midst of a curtailment of 20% of our production volumes. Our decisions on curtailment were the result of detailed analyses of our fixed and variable lease operating expenses, as well as a deep dive on well-specific marketing netbacks. Our technical teams analyzed reservoir performance and concluded that, for the majority of our reservoirs, our wells could be shut in or curtailed without damaging their long-term producibility. This freed us to make decisions solely based upon economic considerations, with confidence that the production would rebound once we brought the wells back online. We also had the luxury of few production volume commitments, so our shortfall penalties were minimal. We are pleased to report that our curtailed and shut-in production has come back as predicted. Hats off to our technical team for calling this one right. Our financial health remains strong. During the second quarter, we generated almost $50 million in free cash flow, $26 million after paying our dividend. We remain committed to our dividend and fully intend to sustain and grow it over time. It is important to our board and important to our management team that we not cut or suspend our dividend during this downturn. So far, so good. We are on track to exit 2020 having generated over $250 million in free cash flow before our dividend, or $170 million in free cash flow inclusive of the dividend. We incurred no incremental borrowings through the first half of 2020. We are committed to reduce our net debt over time. We have no borrowings in our revolver, $1.3 billion in unused liquidity, and no debt maturities until 2024. Prior to our last call, we had reduced our drilling program to a single rig and released all of our completion crews. We discussed our intention of bringing some rigs back during the summer, with the option of also bringing completion crews back sometime during the late summer or fall. Although we are not out of the woods yet, we are sufficiently confident in the stability of the commodity markets to get back to work. We currently have 3 drilling rigs deployed in the Delaware Basin and will stage a 4th rig in early September. We plan to add 2 frac crews in early September as well. Although we're not ready to provide granularity regarding 2021, I'd like to take the opportunity to make a few directional comments. Our plans will generate increased capital efficiency in 2021 and beyond. This is driven by 3 primary factors. First, we will modestly draw down our DUC inventory during 2021. This will not be a major driver of capital efficiency, but it does bear mentioning. Secondly, our cost structure has improved and we are getting more bang for our bucks. Blake will provide additional detail here. Third, we fully expect to achieve better average well productivity going forward. Our program for the remainder of 2020 and beyond will be dominated by development projects. We are relaxing our well spacing based upon recent learnings. We have collected a great deal of data that has led to a working hypothesis that it is more efficient to relax well spacing and compensate for it by modestly increasing completion effort. We think we can recover the same ultimate recovery out of a given drilling spacing unit with fewer wells. Thus, where we once modeled our Delaware Wolfcamp asset at 8 to 10 wells per drilling spacing unit, we now think we can recover the same volumes at 7 to 9 wells per drilling spacing unit. This has significant implications to our capital efficiency. Before we leave the Delaware Basin, I'd like to make a few comments regarding federal permits. Our preliminary plans for New Mexico drilling for the next 3 years, that's 2021 through 2023, include wells on approximately 5,000 net federal acres. Federal permits are good for 2 years and are renewable for an additional 2 years. Although these extensions have been routinely granted, there's no guarantee that this will be the case in the future. We are confident in our approach to federal permitting, but it would be misleading to claim an inventory beyond 2 years. Cimarex is confident that the BLM will continue to grant and renew drilling permits in New Mexico, but this is not without risk. Fortunately, we have the ability to pivot our Delaware Basin program to our Texas assets, which have a deep and profitable inventory life. Don't be surprised if we modestly increase our Anadarko capital in 2021. We have some tremendous opportunities in our Anadarko assets. These opportunities are well calibrated and compete heads up with our Delaware Basin program. Although I would not expect it to be more than 10 to 15% of our total drilling and completion capital, our hunt for returns makes this an obvious choice. Finally, before I turn the call over to Mark, I want to offer a few quick comments on ESG. We have not let up on our environmental goals for 2020, nor will we. We are reducing our emissions, reducing and eliminating flaring, analyzing data analytics on spills to identify systemic root causes and eliminate them, and constantly reinforcing our safety culture. Our commitment to these initiatives arises from our core values, which do not rise and fall with commodity pricing. With that, I'd like to turn the call over to Mark to give you more details on our financials.
Thank you, Tom. Our second quarter results demonstrate the immediate steps we took to maintain our financial health by reducing our capital investment, cutting costs, and preserving cash flow. As Tom discussed, by mid-May, we released all but one drilling rig and halted completion activity, reducing capital investment from $284 million in the second quarter, down 69% from the first quarter levels. Our total cash operating costs, comprised of LOE, transportation, production taxes, and G&A, decreased 12% sequentially from $7.89 per BOE in the first quarter to $6.92 per BOE in the second quarter. The first half 2020 G&A cost includes severance expense of $14.5 million for employees who elected to participate in a voluntary early retirement program offered in the first quarter of this year. This program will result in approximately 10% reduction to our staff and ultimately save $25 million on an annual basis. Also this quarter, we received hedge cash settlements of $64 million, and year-to-date we received $107 million. For the first half of 2020, we generated $451 million of cash flow and $35 million of free cash flow after the dividend. For the balance of the year, with resumption of activity, we project 2020 capital to be approximately $600 million, in line with our guidance assuming an operational restart. With our completion activity starting September on multi-well pads, we do not have any new operated wells coming on production in Q3. We expect to have 10 net wells brought on in Q4, which are coming on late in the quarter and will contribute a minimal amount of production, approximately 3,000 barrels of oil per day for the fourth quarter. We do have strong momentum heading into 2021 with the resumption of completion activity. Assuming similar capital levels in 21 as 20, $35 WTI and $2.50 Henry Hub gas, we can generate free cash flow in excess of our dividend and keep annual year-over-year production flat to slightly up. When we finalize and announce our 2021 budget, we expect to target a capital reinvestment rate of 70 to 80% of cash flow. As we look out over the next several years, with a strong underlying asset base and cost structure, we expect to generate free cash flow in excess of a growing dividend at $35 WTI, with flat to modestly increasing production. At higher prices, we expect to bank significantly higher free cash flow, with a clear goal of having more than sufficient cash to retire our $750 million of 2024 notes, which is our nearest maturity. With that, I will turn the call over to Blake.
Thanks, Mark. Despite the recent improvement in oil prices, we find ourselves in a lower commodity environment than we had planned. Cimarex is continuing our relentless focus on every piece of the value chain. There is not a dollar invested or spent that our organization is not constantly trying to optimize. We are seeing the fruits of these efforts show up in our results. Our operational environment looks much different than it did a year ago. Our current drilling and completion costs are down 23% versus our full year 2019 costs on a per-foot basis. 75 to 80% of this reduction is driven by lower vendor pricing. The remaining is driven by innovation and re-engineering. As we are bidding out drilling rigs and frac crews, we are seeing day rates coming in 20 to 30% lower compared to a year ago. We are also continuing to make strides in efficiency in all parts of our operation. Drilling days in our Upper Wolfcamp program are down 17% year over year, driven by pad drilling and offline cementing. Our stimulation team continues to raise the bar on performance, with our 2020 completed feet per day up by 33% for the same design from a year ago. We continue to focus on every piece of our capital investments, including things like wells per pad versus directional cost, central tank batteries versus flowline cost, and facility sizing versus peak rates. When we deliver $1 per foot on a project, we are seeing the amalgamation of all those decisions, and every piece of capital it took to bring that development online is included. As a result, we are AFing new projects at an average of $800 to $900 per foot across our Permian program. This average includes well costs that vary by area. For instance, in our Culberson County program, we are executing projects at $750 to $800 per foot, compared to our Lee County program, which is coming in at $900 to $1,000 per foot. Reeves County falls right in the middle at $800 to $850 per foot. Cimarex's Q2 lifting cost is down 21% from a year ago. We have received rate reductions in services like rental compression, chemical, and roustabouts, while also reducing our workover activity. We are also seeing new innovations from our ops teams to reduce cost in the field. By using automation and real-time analytics, we have been able to implement a risk-based pump by exception program. This allows us to monitor our operations with closer scrutiny, but with also less manpower. In short, we are doing more with less. Nowhere is this more evident than in our contract labor costs, which are down 58% from a year ago. This same focus on field efficiency is showing up in our Cimarex operated midstream assets, which move 42% of our total company gas and dispose of 62% of our total company water. Because we own and control these strategic assets, we can be flexible and control our cost in times like these, versus being beholden to a contract with a fixed fee that escalates over time. We have been able to release unneeded compression, renegotiate compressor rental rates, invest less capital, and optimize manpower in the field. These valuable assets continue to provide margin expansion and market optionality. When we look across our value chain, we see our cost structure improving at every level. While we can't control where market pricing goes, we can control our efficiencies and execution. Our operations team remains focused on finding new ways to reduce our cost structure and push against the status quo. Thank you.
Danielle, I think that we're open up for a question and answer session.
We will now begin the question and answer session. To ask a question, you may press star then 1 on your telephone keypad. If you're using a speakerphone, please pick up your handset before pressing the keys. To withdraw your question, please press star then 2. At this time, we'll pause momentarily to assemble the roster. The first question comes from Gabe Dowd of Cowen. Please go ahead.
Hey, good morning, everyone. Appreciate all the remarks so far. I guess, Tom, maybe starting with slide 16 and the long-term plan that you guys have kind of articulated. I guess, how does the $600 million in capital kind of evolve past 2021, particularly as you look to spend 70 to 80% of your cash flow, and you also talk about a potentially a mid-single-digit oil growth number?
Well, long-term planning is a little difficult right now. Quarter by quarter is certainly unpredictable, but we're looking at a $35 flat price and how we lay out our long-term plan in 2021. Our capital will float up and down, obviously, with the pricing, but our marker is that 70 to 80% of cash flow, and really our strategic goal is generating maximum free cash, and in particular, we want to have cash on hand to retire those notes. We can't underscore that. We're going to do that. That's really a marker we've thrown down for ourselves, and it's one that we are absolutely dedicated to achieve. Now, we're also dedicated to achieve a discipline. We understand loud and clear the new mandate upon us and upon our sector. And so what slide 16 is meant to illustrate is what that discipline looks like at a $35 price. We don't do a very good job of predicting the price, but what we do a good job of is maintaining discipline. Mark, you want to add anything to that?
Yeah, Gabe, I would just add that, our capital as we go out into the future years, we're trying to target that 70-80%, as Tom mentioned, and it will fluctuate, as Tom said, but there's a little upward trend as you go out into the future years with that capital. But we are staying in that 70-80% is how we're trying to target it.
Got it. Thanks, guys. And then maybe just as a follow-up, I guess, Tom, elaborating a little bit on your spacing comment, I guess, what have you seen thus far perhaps from a productivity standpoint, and I guess what does this mean for your Delaware Basin inventory depth as you kind of tighten spacing from 8 to 10 per section to 7 to 9, as you mentioned?
Well, I'll take those in reverse order. We've recently done a very deep refresh on our inventory, and we're quite pleased with the depth of our inventory. I mean, I think it's probably no surprise that we don't view that we have an inventory problem, and that's given us the luxury to focus more on financial performance rather than reservoir capture. We try a lot of things, and we've got a real science emphasis here at Cimarex, and we've really pushed our teams over the last few years to focus on reservoir, not leaving any wasted resources, recovery, and reservoir efficiency. And we try a lot of things. We have a lot of successes, and we make a lot of mistakes. I will say that as we look back on our program on 19, I think we pushed spacing a little too aggressively and probably saw more well interference than we think we need to achieve. So in analyzing the data of our own program and the science we've collected, we have decided that the depth of our inventory gives us freedom to relax that spacing, achieve greater capital efficiency, and focus those assets on long-term financial performance as opposed to long-term reservoir efficiency.
Awesome. Thanks, Tom.
The next question comes from Arun Jayaram from J.P. Morgan. Please go.
Yeah, good morning. Can you hear me?
Loud and clear, Arun.
I just wanted to make sure. I wanted to see if we could talk a little bit about 2021 and some of the outlook comments. You kind of left us some breadcrumbs around 21, citing how oil production could be flat to up a little bit. We did some math, assuming your $35 break even to cover CapEx and the dividend, we could see strips at 45, Tom, today for next year. If you produce 76,500 barrels a day, that would equate to call it 28 million barrels of overall production, which would support call it approaching $300 million of free cash flow. So first, I wanted to see if my math was in the right ballpark, and talk to us about how you're contemplating dividend increases versus paying down some debt as you articulated in the prepared comments.
Yeah, Arun, I'll start off, and then maybe Tom will want to finish it, fill in any gaps. But with the 21 using the strip price, and I guess we used the strip price a few days ago, like high $43 strip and $2.74 gas, and your statistic around $300 million of free cash flow after the dividend is that is very logical, Arun. So yes, we could be generating significantly more free cash flow if the strip is to be trusted, which we've been obviously become a little reluctant to put too much weight on the strip. We're really focusing on flat price cases, which we think are really defendable, and that's where we're trying to plan around. It's flat price cases.
Yeah, and again, Arun, I'm always going to leave ourselves a lot of wiggle room here. We haven't announced 21 capital, but what Mark's quoting you, the plans we're guiding to discuss around are real plans with real assets. I mean, we've got a material plan that we think we can stand behind. But I'll take the second part of your question. What do we do with free cash? First and foremost, we would like to have enough free cash to call those notes. And I know that, you can look at the pace of that and say, well, if you can generate that much cash in a given year, that's more aggressive and yada, yada, yada. But we'd like to get that cash. Cash doesn't spoil. It'll be just fine sitting, waiting for those notes when they're callable. Now, as far as when that happens, and as we look at the strip, I would concur with your core observation that it will happen sooner than later if the current strip holds, and a lot of contingencies there, but we'll give you that point. We are in the business of working for our shareholders, and so I think you would see us want to increase our dividend over time. And then there's been a lot of talk this season about a variable dividend. That's an interesting concept. I will say that we haven't had a chance to kick that around in the boardroom, but the concept is one that I think is very consistent with our philosophy. So I don't really worry that cash is going to be poorly deployed. I think we understand what our requirement is, working for our shareholders, but first and foremost, we want to generate it.
Great. And just my follow-up, Tom, you mentioned, a reinvestment level for Cimarex at a 70 to 80% of CFO. I just wanted to see if you could provide a little bit more commentary around that. Is that a target at mid-cycle, or how do you think about that reinvestment level, just given the vagaries and ups and downs of the energy cycle?
Yeah, I don't know what mid-cycle means. It's like, what part of the roller coaster do you think was average? We think at fairly anemic prices, we can live within 70 to 80% of our cash flow. And obviously, we're defining 35 as a degree of anemia. But I think the more important point, Arun, is that we will not return to an era of let's put the pedal to the floor and do everything we can. Now, you might say, well, wait a minute, what if prices go to 65? Are you still going to invest 70, 80% of your cash flow? Our goal is, I'm going to return to our DNA here. Our goal is to make prudent investments and generate great returns on investment capital. Now, I want to separate that from what we do with free cash flow we generate, but our DNA has not changed. We fundamentally run this company based on prudent investments, and cash flow is a consequence of good investment decisions, not a primary driver. But we would like to grow our cash flow over time. If we're saying we're shareholder friendly, we want to return cash to our shareholders, I think it's also a reasonable add-on to say, and we'd like to increase our capacity to do that thing over time. And so that's where that 70, 80% kind of comes from, is we're going to be in business for a long, long time. And we're not interested in liquidating.
Great. Thanks a lot, Tom. Mark?
Yeah, thanks, Arun.
The next question comes from Jeanine Wei of Barclays. Please go ahead.
Hi, good morning, everyone.
Good morning, Jeanine.
Good morning. Just following up on Arun's last question there. Can you talk a little bit more specifically about what's driving the range of that 0 to 10% growth over the medium term? Is it really a matter of just setting aside a certain amount per year for that debt repayment and then a certain amount for the reasonable annual dividend growth that you talked about, and then the rest just kind of be directed towards growth? And what does that mean in terms of capital going towards more towards exploration or going after new opportunities more so in the future?
Yeah, Jeanine, we're not really targeting a certain growth rate. That's an outcome of the planning, and we're looking at what our assets can deliver based on the capital range. And right now, again, we're still planning around that $35 WTI starting point. So we're not targeting a production growth range. We're targeting what investments we can make and what those assets then could deliver. So, and we're really not even talking about 0 to 10, Jeanine. When we kind of laid this out at $35 oil, we're talking more like, well, flat to slightly up is how we're mostly characterizing it, or maybe low single digits. But again, our goal is our reinvestment, generating free cash flow, limiting our investments to 70-80% of our cash flow.
Okay, great. Thank you. And then I guess maybe pivoting to the federal discussion, I thought in your slides it was really interesting about the pivot between federal versus non-federal starting next year, since there's only those 46 wells planned over the next 3 years. Can you just discuss maybe relative well productivity or relative capital efficiency between your federal and non-federal wells outside of the spacing augmentation that you talked about?
This is John. I guess, well, it goes without saying that our federal acreage is located in some of the best part of the Delaware Basin. It's in the deepest part, it's the most pressured part, and it's oil in the reservoir. So, and it has some of the better water cuts. So, when we compare different assets, although they all are outstanding, by a little bit more, you would say, the federal acreage is very attractive to us, and thus why we want to get some of that done right now. Yeah, also, as Tom points out, very great nets because it is federal acreage. I mean, they're 87.5 versus 75. All that leads to better economics. But of course, it also means there's a very detailed permitting process. It takes a while to get all that put together. But we're in a great position. And I want to be clear that as much as we really like the opportunity on our federal lands, we also very much like our opportunity, say, in Culberson County, where our well costs are cheaper. Thus, it drives our economics, very comparable.
Great. Thank you for taking my questions.
Thanks, Janine.
The next question comes from Nitin Kumar. Please go ahead.
Good morning, Tom, and welcome to the Shale 3.0 Club. I guess I guess it's fair to say that this wasn't as big of a leap for you as for some of your peers, given your historical returns focus and dividend yield. I guess just following up on one part of it, are you comfortable maybe talking about, is there a total return target between your dividend, your growth, and excess free cash flow that down the road you would like to get to?
I'm going to let Mark handle that. I mean,
Tom and I are looking at each other here, Nitin.
It's like, you can never be too rich or too thin. I don't know if you can be too prolific. But Mark,
right.
You tell us.
Nitin, I think as we mentioned right now, we're really focused. Our priority is to have a growing dividend and in reducing our debt, which benefits our ex-stockholders. And beyond that, as we get a plan with the assets we have, and we're investing at 70-80% of our cash flow, it's going to allow for a significant amount of return to our owners, and whether it obviously is still very price dependent. So to set a target is challenging. That's why, as Tom mentioned, the variable dividend might be a good option to have a regular dividend. But then, if the private environment is much better, we'd have an option to return more to owners, maybe through a variable dividend at points in time. So certainly, our framework, what we're trying to accomplish with fixing amount of capital we reinvest and leaving a balance over for returns is, I think, going to allow for a significant return to our owners.
Then just adding on to that, what I really hope people take away is our commitment to an approach and a philosophy. We can't predict the future, and there could be lots of events unforeseen. Certainly there can be geopolitical events. There can be new policies that are implemented that have a tendency to backfire and could drive oil and gas prices significantly higher. There can be lots of things that we would be forced to respond to that we currently don't anticipate. And it's wonderful for me to say that on the second quarter call, because I've just defined what the second quarter was all about, responding to events we don't anticipate. But what I hope people will take from us is that our commitment is real, our understanding of what we owe our shareholders is real, and we're going to make decisions based on the commitments that we've outlined.
Got it. I guess my next question is a little bit tougher, but in the past you've focused on big projects, and that has led to a little bit of, I guess, inconsistency between quarters, depending on the timing of wells and things like that. In this new world, as you're trying to stabilize operations, you talked about a little bit wider spacing, but I know you're not giving us quarterly guidance, but can you talk a little bit about how the cadence of your spending, your cash flows should trend outside of normal commodity volatility, we all understand that exists. I'm just looking at the operational cadence going forward.
Well, I'll tee that up, and then I'll let Mark comment. I would love to be able to answer that we'll have regular capital cadence, even field operations, and regular production, that won't be volatile. I'd love to be able to say that, but it really is a function of individual projects. And I also say we don't view that necessarily as a quarterly problem. We really look at annual averages, and we would like to see consistent performance on an annual basis. Quarter-to-quarter fluctuations, I know, are confusing at times, but they are a consequence of development projects, which is our most capital-efficient approach. Mark, you want to add to that?
Yeah, no, the development projects are naturally have some variability quarter to quarter, Nitin, but we are definitely on a or maybe relative to historical, where we did have more probably back-end loaded programs at times. We were flexing up and down frac crews. In this kind of a market, I think we're definitely focused on having a more regular cadence, but that doesn't necessarily translate exactly into a production cadence that's completely level. So in this environment where efficiencies are so important, having that kind of regular operational speed is also part of the efficiencies we can gain.
Excellent. Well, thanks for answering my questions, and congratulations on a great quarter.
Thank you, Nitin.
The next question comes from David Heikkinen of Heikkinen Energy Advisors. Please go ahead.
Good morning, and thank you for taking my question. I've been thinking about the space as a whole. I think y'all can be helpful because I'm pondering like this lower cash flow break-even pricing, but then like where companies will fall as far as long-dated returns on capital through the cycle. Like I can imagine, an Exxon having very stable base production and ability to stabilize that, but generating low returns on capital. And I'm not trying to pick on Exxon, but as I think down the group, as you invest 70 to 80% of cash flow, what do you think your corporate return on capital employed should stabilize at?
Yeah, David. We obviously still somewhat price level dependent, but if you look at the at a strip kind of environment, looking at our return on capital employed, we would probably expect it to start stabilizing in the teens. It's probably high single digits to low teens is probably likely where we could be at on return on capital employed. Accroci in high 20s to low 30s.
Okay.
Yeah, David, let me just jump in here. I think it bears mentioning that I'm going to sound like a broken record here, but it's all about return on investment capital, and that over time will lead to a return on capital employed at a corporate level. At $35, we have scrubbed our investment landscape, and these opportunities generate very, very nice returns. Now, they're helped by the lower cost structure, but that's all tied to the commodity price. These are returns at a $35 250 price file that we are very, very happy to make, and we think we're well calibrated and are very confident that we're investing prudently.
That's great. Thanks. That's just something I've been thinking about.
The next question comes from Doug Legate of Bank of America. Please go ahead.
Thanks. Good morning, everyone. Thanks for taking my questions also. Tom, this is a very consistent message from what you've had for a long time, I guess, in terms of focus on returns. So glad to hear you. The first one, I think, to phrase it as Shell 3.0. So my question, I'm afraid, is a clarification on the slide 16. You've talked about single-digit growth, and I guess it's about the 70 to 80% reinvestment rate. Single digits is 1 to 9%. It's a pretty wide range. What are you trying to signal here?
Yeah, Doug, we were just trying to signal that at a 35 and 250 type price environment, our assets can deliver flat to slightly up. Low single digits probably would have been a maybe better term to put in there than just single digits. But we are saying that our assets can not only generate free cash flow beyond our dividend, but we also have a flat to slightly up production profile.
Yeah, Doug, you're giving us way too much credit for signaling, reading the tea leaves. What we did is we just said, all right, let's just say, what if we were to hold capital flat at a $35 price? And, we obviously looked to optimize our program, and we found that we could generate a little bit of oil growth next year, generate free cash flow after our dividend. There really wasn't any intent to have a deeper message than that, and we didn't really spend a lot of time iterating it. We just said, okay, that's a good result. Let's just disclose that.
Thank you for that. My follow-up is, if I may go back to your comments about the interesting discussion around variable dividends. And I think poor Karen has had to put up with my questions about free cash flow and DCF and all the rest of it for a long time. But we laid out a pretty transparent view of your value this morning in our note, and I wanted to just poke you a little bit on this, because what you're laying out is a tremendous free cash flow yield story. And there are a couple of ways to grow your dividend. One is to grow the dividend burden, and the other is to buy back your shares. And right now there seems to be a fairly wide value gap between what your stock represents as a free cash flow story versus where it's trading. So why is buyback not part of the story in addition to variable dividend, in addition to the base dividend growth?
Well, Doug, we're certainly focused on as we've laid out on slide 16, our initial focus is on investment in what we think conservative price deck that would allow us to grow or increase our dividend, maintain flat to slightly up production, and then further, the most important item for us is to retire our notes in 2024. We want to get back to, we've had a long history, have a very low levered balance sheet. We feel our balance sheet's in very strong shape right now, but we'd like it to even be sub 1 in a mid-cycle price environment, whatever that means. But we're at 1.6 times trailing 12-month debt to EBITDA right now, paying down those notes and having EBITDA growth, slightly EBITDA growth. We think we should be targeting the less than 1 time debt to EBITDA. So our debt focus is primary right now, and as time goes on, we'll see what other avenues we want to take for free cash flow.
Yeah, but Doug, I want to be clear. We are not taking a buyback off the table. I mean, that's certainly within the realm of a discussion fairway. Our board has had lots of discussions on buybacks. We haven't embarked upon one up till now, but it's a reasonable question. I just want to leave you with it's in the fairway of discussion.
Well, tremendous messaging, guys, and I hope you and your peers can succeed in bringing investors back to the space. So thanks again.
Thanks, Doug.
The next question comes from Matt Portillo from Tudor, Pickering, Holt. Please go ahead.
Good morning, all.
Hey, Matt.
I had two quick asset-specific questions. Wanted to see if you could flesh out a little bit more detail around the spacing design change from 2019. It sounds like you're having some positive success with the wider design and completion change. And just curious if you could provide any color as to how your leading edge results are comparing versus the 19 vintage and how that's improving capital efficiency heading into 2021.
Yeah, Matt, this is John. Really, as a follow-up to what Tom said, we are recognizing that for a good part of our acreage going forward, we can essentially achieve the same total recoverable reserves for a particular drilling spacing unit with just less wells, which just means relaxed spacing. Or to put it another way, the amount of overlap between wells was quite frankly greater than what we originally anticipated when we first designed those particular developments. We got it wrong. I mean, that happens sometimes. But what we recognize, though, is by pulling back some, you're now looking at achieving the same ultimate recoverable with far less capital. And that's where the efficiencies come in. And we feel very good about that based on some of our more recent results and really where we're guiding to. And that's why we feel very good going forward about our expectations for that acreage, both in Reeves, Culberson, and in Lee.
Now, this is only true for the Wolfcamp.
Yes.
Because we're still, we really have some amazing projects in the Woodford. And that's a totally different reservoir, and it's a different conclusion. But
It's fair to say it's everything I was speaking to was directly related to the Wolfcamp. Quite frankly, when you think about other intervals, even within the Delaware Basin, whether they be Bone Springs or Avalon, we feel very good about our spacing choices there going forward. And then likewise, as Tom said, when we do put more capital in Anadarko, we have a wealth of history behind us there that we feel very confident in our spacing decisions there as well. It's been within the Wolfcamp that there's been a major learning over the last year and a half, and we've made that now adjustment, and that's what you'll see us doing going forward.
Great, that's very helpful. And then just a second question on the asset front. The rock in Culberson obviously is extremely productive and highly capital efficient. On the slide deck you provide, you show your Culberson results, which are really a standout. I was curious on Reeves County, because that is a decent portion of the mix heading into 2021, how you view your results in Reeves relative to Culberson. I think there's a lot of just noise in the industry data given the delineation and downspacing that occurred around Reeves. And so I was just curious how your results compare between those two basins on the drilling program for next year.
Well, again, this is John, and I do recognize that as much as we show an average Reeves result on that slide, which is page 12, I can at least tell you that when we've reviewed our efforts relative to peer companies, we feel very good about our results. But that said, we also recognize that 19 was not our best, that it's going to get better. And again, that's some of the overspacing that was done in Reeves for us, and thus are backing off some in terms of total well count in Reeves. But again, I can tell you that when we've looked at other projects in the immediate area, we feel very good about our frac design, very good about our landing choice, and very good about our go-forward economics there.
Thank you very much.
The next question comes from Michael Scialla of Stifel. Please go ahead.
Hi, good morning, everybody. You said your 21 plan could probably generate $300 million plus based on strip prices, and Blake showed slide 11, your current well cost AFEs. Are those the costs that are built into that 21 plan, or where do you expect those to go directionally next year?
Yeah, this is Blake. Those costs are directly out of our 21 plan. So those averages we're showing, those are real AFEs. Those are real bids that we're getting today, and that's what's plugged directly into this model.
And Matt, Michael, I might just point out that those are real costs, as Blake said. I know a lot of people talk about pacesetter costs or leading edge costs, and that's a really good thing to talk about. But these are really well calibrated. These are based on actual results, and we're highly confident not only can we achieve them, but we have achieved them.
Very good. And one of the other drivers behind the improved 21 capital efficiency you anticipate, Tom, you mentioned modest drawdown DUCs. Just want to see if you could put any numbers behind what you're anticipating there.
Well, we haven't given any numbers, but when we do have a 21 plan. This is not arm waving, but the only reason I use that terminology is because when we look at our beginning of year DUCs versus end of year DUCs, on our current scenario, there's not a huge difference. So we're not doing a major drawdown. But again, we really don't want to get more granular than that because we haven't announced our 21 plans, and I'd hate to put something out there that then would be modified. But I'm just really, my point is I listed 3 elements of capital efficiency, and I think the DUC part is probably the minor contribution of those 3.
Great, thank you.
The next question comes from Neal Dingmann of Truist Securities. Please go ahead.
Morning, Tom or Mark. My question is, I'm just curious as to how you all think about your 21 plan, including potentially returning Anadarko, and how this will alter, or what's the sensitivities to gas and NGLs on this plan?
Well, I'll tee it up, and I'll let either Mark or John follow. But the Anadarko projects that we would stage in 21 are very liquids rich, really nice oil production, And so, depending on how the commodity swings, they look as robust as our Delaware investments. Mark or John, you want to follow up on that?
Yeah, I'll just mention, Neil, that, the areas in the Anadarko, we've had some areas we've really had high regard for, like particularly around Lone Rock. And there's some returns in there that as we continue to see strengthening of gas prices and NGL prices are also a boost to it, but they're a high liquid oil component. So those returns, as we look at them, they are very competitive to the Permian, and we've been under lowering our investment in Anadarko, but there's certain areas there that definitely deserve some capital.
Okay, makes sense. And then just lastly, certainly a positive outlook for 21, especially on the backdrop of just the volatility we've seen in 20. And so I'm just wondering that expectations for kind of flattish oil with a flattish or so CapEx. I'm just wondering, Tom, you've hit around this a lot on the call today. Is this just driven more by efficiencies? I'm just wondering, are there other things that are driving that, or what is really behind that sort of 21 that you're able to do that after, coming off such a difficult year this year?
Well, it's driven by lower costs. Certainly, we're getting, as I said, more out of every dollar we invest, and that cost structure is across the value chain, as Blake outlined. Our organization's been tremendously creative in scrubbing all elements of our cost structure, which, operating expenses always seem to get a backseat to this discussion, but they contribute handily to our netbacks. It's driven by asset performance. This plan is driven by calibrated go-forward results. When you have great assets, great organization, a low cost structure, it shows up with the roll-up, and that's what we're talking about.
Very good. Thanks, guys.
Thanks, Neil.
The next question comes from Brian Singer of Goldman Sachs. Please go ahead.
Thank you. Good morning.
Morning, Brian.
Hey, Brian.
As you think about the best ways to invest capital, do you see value at this price level and at current valuations in the market in pursuing acreage expansion or any kind of consolidation towards lowering the cost structure of your current assets further? Or is what you're addressing with the costs having come down and maybe the slower pace at wider spacing is sufficient where investing in the drill bit is likely to remain more competitive than M&A?
Well, we're in a cyclic business, and anything I say is subject to cyclic overprint. But we've always preferred investing through the drill bit, and that is always with us associated with a low entry cost. Investing through the drill bit is a half cycle discussion, and if you don't include what you paid to acquire the asset, you're misleading yourself, much less the investing public. We are always interested in good ideas that have a low entry cost. And I will tell you that John and his organization is hard at work finding additional good cash flow through opportunities that we can enter cheaply. And that's always going to be a part of our business. It's probably the most challenging part of our business. It's probably the least predictable part of our business. And it's probably the one that we can least plan around. But it's always going to be a part of our business. We've got some things on our plate now that I think are testament to some outstanding work from John and his team that if we could get a very low entry cost, they might be a significant part of a future cash flow generation. M&A is more episodic. It's pretty tough to predict the kind of consistent value generation through M&A that we've found through drill bit growth. Not that we're not open to it, not that we're not going to be opportunistic, but our core strategy is built around the drill bit.
Great, thanks. And then my follow-up, you've talked a few times here about the goal of getting to that $750 million of cash to handle those maturities in 24. Is the message that you would be or you would want to stay at the low end of a 0 to 10% or 0 to mid-single digit type growth rate until that $750 million is in hand, or is there any kind of balance within the range?
Yeah, Brian, that's right. We have to really emphasize the importance of us paying down those notes, and those low single digits or single-digit growth. It's not really the primary driver, Brian. The primary driver is reinvesting in the business, retaining free cash flow above our cash flow. And you keep reiterating that we'll be targeting 70 to 80% of our cash flow for reinvestment. So the growth rate will be an outcome. It's never been our primary focus. It's more of an outcome when we look at the investments and we roll up the investments that we're planning to make during a particular period.
I think maybe I should have rephrased. Should we expect the low end of the 70%? Should we expect more of the 70% side of 70 to 80% reinvestment until the cash is in hand for the $750 million?
Yeah, Brian. I mean, there's a lot of moving pieces, and we're just trying to set a framework for ourselves. And certainly there's a price over print, and as Doug Leggett made the comment, or I guess Varun, it's $45 strip price right now. That's a significant amount of free cash flow in 1 year. So we're trying to balance all the inputs with a framework by which we can manage to generate free cash to pay off those notes.
Thank you.
Thank you, Brian.
The next question comes from Leo Mariani from KeyBank. Please go ahead.
Hey guys, wanted to follow up a little bit on the spacing comment. It sounds like you guys have certainly done a lot of work on that. Just wanted to get a sense from you folks of what you think kind of the quantitative implication is from the from the wider spacing in the Wolfcamp. If I was to say, throw out strip pricing, call it, $45. Could you maybe say something like, we think the IRRs are 5% better or 10% better? Any help you could kind of give us with whatever internal study you've done on the spacing?
Well, the IRR is going to be more than 5 or 10% better. John, put it well. If I conclude that I can drill fewer wells and get the same reserves, I think I'm also admitting that we've over-drilled in places. And so the return uplift, if you can eliminate that, is tremendous. We've done a lot of work on this, and I know that a lot of our peers are in the midst of doing their own good work on this. It's not just a well spacing side to side. We've learned a tremendous amount about the vertical communication in these reservoirs, and a lot of what we learned has surprised us. But every bit of science and every bit of learning that we do here at Cimarex is completely with one goal in mind, and that's increasing our returns. And yes, it will have a significant return uplift.
Okay, that's helpful. And I just wanted to follow up a little bit on the outlook as we look into the next couple of years. Certainly, as we've already noted on this call, $35, maybe feels a little bit, conservative, particularly in the out years at this point. Just wanted to kind of, get a sense of how you think about balancing, dividend growth with building the $750 million cash to redeem the notes. Do you kind of want to have just better line of sight and more progress on the $750 before you can start accelerating the dividend? Is that a fair way to think about it?
Well, we have enjoyed. It's a happy moment in our boardroom when we increase our dividend. We all come away satisfied because that's what we're here to do is work for our owners. So I don't think you necessarily need to see us wait until we had a huge amount of progress on that $750 million number before you saw us increase our dividend. Mark, you want to?
No, I think I think those are pretty comparable goals. Both are very important to us, and I think we can manage both. I think we can have a pattern of growth of our dividend, which we've historically had. We've been a dividend payer since 2006, and we've had a nice pattern, interrupted only once during the financial 14 and 15 period, and we want to get back on that pattern of growth. That's a high priority, as well as it's building cash to pay off the debt. So both are equal high priorities to us.
Thank you.
And if there are no further questions, I'd like to turn the conference back over to Mr. Jorden for closing remarks.
Yeah, in closing, I just want to thank everybody for your attention. And, Cimarex has always been a company that wants to be measured by our results. We've laid out for you some clear goals that we have, and we look forward to generating results. Go forward talk is always a lot of fun, but we intend to be able to look in hindsight and demonstrate to you that we've achieved these targets we've set out. I also want to encourage everybody and wish you well. Hopefully your organizations, your families, and you're all staying healthy during this very challenging time. But thank you very much for your attention, and it's just been a pleasure to talk to you this morning.
The conference is now concluded. Thank you for attending today's presentation. You may now disconnect.